Hey, I'm live. How are you?
Good. How are you?
Oh, great. I'm great, great, great. I know you're doing the Keller Williams Red Day, so thus the red shirt. So
Yes, it's the red. Yes. So every year we stop doing real estate kind of, and we serve a community. And so this year we are planting trees and flowers and making things pretty for the women's center here in Fort Worth. And we are trying to make it pretty because they do amazing work for these women that have been battered and or like they've experienced some major trauma. And so just coming to a place that can truly like reflect what they're doing in the inside, outside, in the outside as well, is what we are striving to do.
that's great.
Yeah.
Well, yeah, I always say if you have a plan to get, you better have a plan to give. So
Yes.
that's a good thing.
Yes. Yes.
Well, what we are doing this week, as we're doing several of these live topics, as we're leading to a home buyers class, navigating home ownership class for June the 7th. And I know in the chat and
Right.
Me Day is going to be sending out that information. And we've had lots of topics, and we've got lots of topics coming. And last week our topic was, about listing your home and when to be ready. And one of the things that came up in that conversation was when you go to visit with people before they list, is you try to make sure, are they ready? Are they prepared, to buy something else? When's the last time they checked their credit? So then that led us to this topic, which was credit cleanup. And you're
Yeah,
cleaning up today, which is kind of
I am.
coincidence.
Yeah.
You're
Yeah. It's
cleaning up
kind of, yeah.
today, doing the red
Cleaning up
day,
today.
as our
Yes.
topic is
Yes.
credit cleanup. So
Yeah.
I have a flyer too that I can share along with our live here, 7 tips to improve your credit score. And I can get that shared here in a second. But we have what I like to refer to as frequently asked questions. So,
Yeah.
hit
Yeah.
me with some good
Uh,
questions.
all right. So one that I get a lot is what is your debt to income ratio? What should that be at ideally?
That's a
Because
great question.
yeah, yeah,
The great, and I love the fact that you asked that question because we in the real estate side, but in the lending side, we use a lot of short words or analogies or acronyms, and the average person doesn't know what that means. So when we throw about our words and we say debt to income ratio or DTI, people don't know, well, what does that mean? And so debt to income, monthly debt is your monthly obligated debt divided by income, including the new mortgage payment. That's how we calculate it. So what happens is when you have a balance, so let's say your balance on something is $5,000 and my balance on something is $3,000 of what's owed. The monthly obligated debt is what we care about, not the balance. Because someone with a $5,000 balance, their monthly obligated debt, they might be obligated to pay uh, $150 a month. But the person with the $3,000 debt, which is lower, their monthly obligated payment might be $200. And we're not necessarily concerned so much about what you're making the payment for, as long as you are at least making the monthly obligated payment. Because by making that monthly obligated payment, your credit scores are better. You don't have lates and things like that. But when we're looking at loans or lending and so forth, that's the main thing is your monthly obligated debt divided by your income, including the new mortgage payment, so that we know that when we provide you and your team a letter, that they're prepared to be able, they're qualified and prepared to be able to purchase. And one thing else I'd say is any installment debt. So sometimes people have car payments, and car payments is considered installment debt. And if there are less than 10 payments, then we don't have to attribute that to the overall debt. We don't
okay,
have to count that monthly payment to against them, which is great. And then
okay,
other monthly obligated debt is student loans. Some people have student loans, and those student loans are deferred, and we can apply for that debt maybe a 1% payment, or if they're on an income based repayment plan, we can take that income based repayment plan and use that as the monthly obligated debt.
hmm
Or sometimes we'll even do a Freddie Mac type loan hit them with just 0.5%. And if they're going to look for like an FHA loan only requires us to hit the student loan debt now with the 0.5%. So that was a long answer
awesome.
to a short question.
That was pretty long. Yeah. So another question is, how should I be utilizing my credit? Like, a lot of people have credit cards. I get it. You have to use credit to move up here, and you have to have credit so that way you can buy your house, because not everybody has stacks of dollar bags and just put away, and so
Right.
how do you like utilize that? Can you explain that a little bit?
Yeah, so twofold question, which is great. You really want to have your overall credit of all that you have available to you. You really want to utilize 33% or less.
Okay.
I think sometimes the other thing is, I think sometimes people move balances all around, and that's not always beneficial. But when they're creating a FICO score, they want to make sure that you're properly utilizing the amount of debt, that they're not all at the verge of the limit. Just because you have a $5,000 limit on a credit card, or I remember the first time I got a credit card with a $20,000 limit, and I didn't ask for the $20,000 limit. I have good credit. They said, okay, your credit card limit is $20,000. And I was like, ooh, okay. So you don't have to utilize all that credit, but you definitely have all the credit that you owe for everything, your Kohl's credit card or your Visa or your MasterCard.
Yeah.
You just want to utilize, and the highest chance for a credit score is the utilization of 33% or less. And there was something else I was going to add to that, and I can't remember, but those are
that would 22,000. My goodness, that would have been like a total major shopping spree. I'm all like, did you get yourself in trouble?
No, I would say,
Okay, good.
No. I would say that the people that get themselves in trouble, including me, is when I was in college, at a young age, and got my first credit card with, like, it had $1,500 balance, and I might have had a few pizza parties, friend pizza parties, and all of a sudden, wow, this bill comes and you got to actually pay it, I'll follow that up by saying this. The thing that most hurts the credit is the history. The best predictor of the future is the past. And when we're in a situation where we're trying to lend money, we're looking at it from the ability to repay. The ability to repay is paramount over everything else. And so when we're looking at the ability to repay, paying on time and not having lates and a history of lates. Sometimes I'm looked at a credit report and I can't provide them with a pre-qualification letter because they have stuff that's in the rears that's owed. And I'm like, get everything current and then let's talk again,
Okay.
Because you can't do credit repair on anyone if they're in late. And that is the thing that hits the credit score the hardest is late pay. So you don't want late pay 30, 60, 90 days with a late pay. You don't want that.
Okay. How does someone start? Like, I guess my next question would be how does someone get started? Like, say you're fresh out of high school and your goal is to own your first home by the time you're 25. Or even 19 or 20, how do they get started?
Yeah, that's exciting. Those are good goals too. I think the best way for people to get started is if they have a checking or a savings account at a bank, then that bank will have sometimes what's called a secure card. And a secured card means that you put a deposit of $500, and then you take that card that has that limit on it that you've secured and go buy some gas, and then pay that off. The bill comes and pay that off. Maybe buy some groceries, something that's small that that you can turn around and pay that off as soon as the bill comes. Those are the things. The other thing is that as parents, if we have good credit and we want to establish credit scores for our 18 and 19-year-olds, one option that you can do is create a credit card, or you'll have a credit card where you make them an authorized user. And just because you make someone an authorized user for emergency only It doesn't mean that they have to carry that card with them. But if you have good credit and you want your children to have good credit, if you do create them as an authorized user, they will get the benefit of your credit score. Now, if you make a mistake, they'll get the benefit of that too. So,
Oh yeah, you gotta be careful with that.
yeah, so we want to be careful. But I know that what helped me establish credit was I was an authorized user early on one of my dad's credit cards, and that was very helpful. Now, he just didn't let me carry the card with me because I had maybe already done the pizza buying credit card scenario in college.
Yeah.
But yes, that's another way to be able to do it. And then when you're building credit, you need certain different types of credit. You don't need just all department store credit cards. You need different types of, credit. Maybe a car loan, even if it's small, a car loan is a different code, if you will. Mortgage inquiries are a different code, that kind of thing. So, get 2 or 3 or 4 different line items of accounts that you're paying on time.
Okay. That's great information. So another question that I get or I run into is I have filed for bankruptcy. When is the next time that I can apply for FHA? Do I even qualify for FHA, or is this like I'm never going to be able to buy another home ever again?
So the thing about bankruptcy is if you're in a position where you ended up filing bankruptcy, as long like with FHA, you have to wait 2 years. In that 2-year time while you're waiting from the discharge date, it's always from the discharge date of how we're making the judgment. So with FHA, what I say is not only do you have to wait 2 years from the discharge date, but you also have to be in a position where you've not had any more derogatory credit after the bankruptcy. So after the bankruptcy and going forward, 24 months, just no more, nothing late, no derogatory credit during that time.
So 24 months after no derogatory, and right. you can okay.
And when we're looking at credit currently, the one thing too I'll add is that we don't right now we don't count in your monthly obligated debt. We don't count medical collections, and we don't hit you with when you have some medical collections. And we're getting to the point now where that's not a proper way to report, where medical they can't report that to your credit. But I know a lot of people are fearful to apply for a mortgage loan because they're like, oh, I have medical collections, and we try to not count those towards making the decision.
Now, say, does that make a difference? Say, like you are like a habitual, like not paying your medical bills, like ever. Does that make a difference, or is this just like you've got just a couple that just
anytime there's any type of history that's, when we're trying to put people in position to purchase and we're trying to improve their mortgage situation, there's the best predictor of the future is the past. And so we don't want someone that just habitually doesn't make their payments. But sometimes I know of people especially with medical collections, they've made their payments. But insurance and all that kind of stuff, are not communicating, I guess, is probably the best thing.
Okay.
And so I know that people get frustrated with that.
Okay.
And I'm going to see if I can share the screen.
I was going to ask you one last question. What impact does credit score have to your interest rates? What is that doing right now?
Yeah, it's a big deal, and it's tiered, right? So the lowest credit score that we can do for like a VA loan, for example, is a 600 credit score. Most everything else you need is 620 or better. And we throw out the high and the low and go with the middle score. And as long as the middle score is 620 or better, then we do have a fighting chance. But we look at it in thresholds. So if someone's got a 640, what can we do to get them to a 660 or a 680? What can we do to get them over 700? Because for as much of that distance, the interest rate will be improved. It'll definitely be an improvement. In some cases, it's a half a point improvement. You want good scores, and anything above a 680 is considered good. Anything over like 720 is great, and that's the direction that we want when we're trying to apply for mortgage loans. In conventional financing, you can do conventional financing as a 620 or a 630 or 40, but it may require more down payment because the credit scores aren't there. So if you want to minimize what you have to do in down payment, you can do a conventional loan with only 3% down.
Okay.
But also it's helpful if you're doing 3% down, if you also have a credit score that's, 680 or above.
Okay. Yeah. Okay. Awesome.
And
Awesome.
and on this flyer that I provided with the last few minutes that we have left here, it just gives us 7 tips to improve your credit score. If you send us an email, we'll send this flyer to you and you can have it. It just says limit the number of inquiries on your credit. And what that's saying is you don't want to go and you go to Kohl's and apply for a credit card, then you go up the street to Target and apply for a card, then you go and you apply for a car loan, and all of a sudden you have all these different codes and different inquiries. So if you can prevent that, that will keep you from driving it down. Now, when people are mortgage shopping, you can run a credit with different mortgage companies, over the course of 14 days, and
Okay.
everyone's going to get the same score. So you're allowed to shop a little bit, but we don't want the inquiries to be crazy. As I mentioned before, pay off debts and past due balances. If you've got some collections, you can try to negotiate those as settlements and called pay for delete. Like, I'm going to pay you, but you got to delete this off my credit. We work with Rising Point Solutions and Amy Martinez to help with that. If someone needs what we like to call credit restoration, we've got some bumps in the road, we need some professional help. Avoid large purchases on credit cards. Don't use that $20,000 limit credit card to go buy a car, or these days you can't, but you don't want to max out the credit cards with some huge, large purchase. Only apply for credit when you need it. You need a credit score and you want to do a secured card, that's fine. Pay all your bills on time. Fix any errors on your credit report yearly. So you can do the annual creditreport.com. You can get your annual credit report and take a look at it and see if there's any errors on it. So
that's awesome. Awesome.
I can talk about all kinds of credit. We could do part 2. I see it all,
I know. Yeah. Yeah. This is awesome. This is something that I'm always asked, and I always have to direct it back to you because I don't know that part. I know houses, I know how to negotiate contracts, but I like this right here. I'm staying in my lane, and that's all you, because I don't understand it whatsoever.
I gotcha.
So, but yeah.
Well, when people ask me about houses, they go, "What do you think of this house? What do you think of that?" I'm like, "What does Celia think?" Because
yeah.
it's good. Keller Williams agent, she's going to get it going on. So
Yeah.
I'm going to let you get on with your red day and your park cleanup, as we just provided the credit cleanup. Provide some lending guidance on our side too. So
absolutely.
You have a great day, great cleanup day.
All right. Bye, Stacy. Talk to you soon. Right. Bye.
Bye-bye.